All right, so this will wrap up our income statement part of Chapter 4. Believe it or not, we're still in Chapter 4, and we will still be in Chapter 4 for the next statement of cash flows. What we see now in Chapter 4, something actually that's not in your Chapter 4 in the book. It's in Chapter, I think, 21, but I teach it in Chapter 4 because I've always learned it this way, and I've always taught it this way. But there are accounting irregularities that occur and how they incorporate into how we present things on the income statement, the balance sheet, and the statement of retained earnings. Okay, so the first thing is the changes in accounting principle. We just discussed that in the statement of retained earnings. Remember that I said one example is changing from LIFO to FIFO. One thing that is extremely pertinent is that it's a change from one generally accepted accounting principle to another generally accepted accounting principle. Because if you switch, for example, from something that just is not accepted, that is non-GAAP, to something that is GAAP, that's a correction of an error, which is a different sort of adjustment. Okay, so we have three irregularities. We have a change in accounting principle. We have the correction of an estimate, and the correction of an error. So three different types of changes and three different approaches for how we're going to handle those changes. So the change in accounting principle, one generally accepted to another generally accepted, could be like changing from LIFO to FIFO, changing revenue recognition methods, changing from the gross method to the net method, changing from using a perpetual to a periodic system. Things that a lot of things will come up over the course of the semester as you learn more and more ways, more and more choices that managers have. And again, it's going to only be defensible when the new standard is preferable. So we just can't change because we feel like it. We have to provide a well-reasoned argument for changing principles. Of course, it would be up to the auditor to really investigate whether this is a well-reasoned reason. The application of the change, we need to retroactively restate all comparative financial statements to show the new method. Sorry, this should be right here. And what I mean by comparative financial statements, well, any financial statement that we have will typically have a comparative year. I'm reaching for the balance sheet real quick that I have here. So for example, this is Target's balance sheet. There are 2 years. The present year that we're the present date. So this is as of the end of January 2016. So this is reporting for the year 2015. This is the same end of month, but is reporting for 2014. And it's comparative, right? Because then we can make comparisons between the two. So if there's a restatement, we have to restate account totals for any year that's actually shown on the financial statements, right? We don't have to go back and restate the others. It doesn't make much sense because those will not be present. However, we have to, for those years that aren't shown, we go back and then we calculate what effects this had on net income in all of the years preceding the comparative year. So in this example then, because this represents operations for year 2014 and where they ended up, we would then have to go to 2013, look at that, 2012, 2011, all the way back to Target's incorporation to figure out how this change will affect net income, okay? After we do that, we redo all the financial statements since the company's inception using the new accounting principle. Really, the balance sheet doesn't have to be redone because of the nature of the balance sheet. Just trust me on that for now. We'll talk more about it in class. However, the income statement will flow into retained earnings every year a little differently. So we redo all of the net income and then have that be an adjustment to the first comparative year. So again, in the case of Target, we would adjust the retained earnings for 2014, the beginning retained earnings of 2014, and that would incorporate an adjustment for all the years prior to 2014. Okay. This is the toughest one, FYI. So, If this is kind of bogging you down, repeat the video, get it down. I'll do an example in a second. So I give you a small example. Assume the company reports 2 years on its financials, the current and the prior. In this case, let's assume they're 2017 and 2016. If the company decides to alter an accounting principle, it would calculate the effect of changing principles on net income for all years prior to 2016. Remember, this would then be the first comparative year. Then we would sum up all these effects and apply them to the beginning retained earnings of 2016. It would be a net gain or loss, and we would want that to be net of tax because everything in retained earnings is net of tax. We then would restate the income statements of 2016 and 2017 because we would actually have to alter the face of the financial statements for these 2 years because they are both reported in the current financials, 2017 and 2016. Okay. If we change LIFO FIFO, cost of goods sold would have to be altered. Also, and I was remiss, the balance sheet. If we change from LIFO to FIFO, there would be an adjustment to inventory. And we would have to restate inventory for 2016 and 17. This is my horrible ampersand. Right. So instances that are not considered a change in accounting principle, basically when something's occurring for the first time, something that was previously immaterial, or like I said, if something was not an acceptable accounting standard, if it was non-GAAP, then that would actually be the correction of an error. And we'll talk about that in a second. So let's look at Herculean Industries. They've recently altered the revenue recognition estimates from sales. This is a change from one accepted approach to another, which again is important because otherwise it's a correction of an error. The company has decided to enact the change during the fiscal year ending 12/31/16. It reports 2 years of data on its financial statements, the present year and the preceding year. The company incorporated in 2013. So we don't have to backtrack too much, but we have the following information. So we have revenue estimated under the old method, revenue estimated under the new method. What should Herculean report for its 2015 and 2016 revenue? How much and in what year would Herculean adjust its retained earnings? So if we decided during 2016, it records, remember, the current year and the prior year. So these are my two comparative years. The revenue then, first thing we need to do is figure out the adjustment, the cumulative adjustment would be looking at the difference between 2013 and 2014. So under 2013, right, it looks like we have 1,278,000 under the new method. We had less under the old method. So it looks like we had a gain of $11,500. And then in the next year, we had a small loss, 1,371,250 under the new method and 1,375,000 under the old method. So yes, we had a small loss of 3,750. So we combine these two. And that is my cumulative adjustment. Now notice, this isn't net of tax. And so again, we'd have to net tax. And again, assume a 40% tax rate, which means that the after-tax tax rate is 60%. So after I adjust for that, means that I would adjust it by $4,650. I would increase retained earnings. And I would do that in 2015 because it's the first comparative year. What would I report in 2015 for retained earnings? I'm sorry, for revenue. 2016, well, then I would just report it under the new method. It would replace what I had previously. So those are the revenues I would report under new method. So if you notice, this will roll all of the corrections in, because first we figure out what the correction would have done to the prior years. We roll that into retained earnings. Then for the years we've actually have comparative financial statements for, we have this correction, which would go then into retained earnings. It would alter retained earnings. We have this correction, which again would alter retained earnings. And so we have actually accounted for all the corrections that would occur through this method. A change in accounting a change in accounting estimate is just something that happens, right? It's a normal recurring adjustment because we have to make estimates in accounting a lot of the times. And sometimes they don't pan out despite our best efforts. So, changes in the estimated life of a fixed asset, salvage values of fixed assets, changes in depreciation methods, all of that would affect depreciation expense. The change in the collectability of receivables. If I started to think that I had more bad debts than I was previously anticipating, that would affect the calculation of bad debt expense. The adjustment for what I think I can realize from my inventory would affect what I would realize on the lower of cost or market. We'll get more into these things and talk about it again as they come up in the later chapters. But note that these are all good faith, changes from a good faith or reasonable estimate. If there was bias in the prior estimate, if there was some sort of manipulation going on, that it was purposely incorrect, this would be a correction of an error. So again, there's some gray area here. You have to make sure that this was a grounded, rational estimate in the first place and not one that was purposely misstated. The nice thing about changing accounting estimate is it only affects current and future periods, so there's no retroactive restatements that occur, no cumulative adjustment to retained earnings, because all we're going to do is change going forward, and so it only affects future net income, well, this year's net income, because we're changing it this year, and future net income. The correction of an error is different, right? It's a mathematical mistake. It's an accounting estimate made in bad faith that was purposely incorrect, or maybe a misapplication of accounting principles when we switch from something that's non-GAAP to GAAP. Well, what we do here is handle it as a prior period adjustment. In the year the error is detected, we report that discovery of an error as an adjustment to the beginning balance retained earnings. So for example, if we're in 2017, and we detect an error that happened in 2013, we don't do a retrospective 2013 adjustment. We just adjust 2017 for that error because it was the year we discovered it. Okay. So let's, going back to the Herculean example, suppose that the company decided to alter its revenue recognition, but discovered in 2016 it made a mistake in calculating its revenue in 2013, right, resulting in a $4,500 overstatement. By what amount and in what year would Herculean need to make an adjustment? So they overstated their 2013 revenue. So that's the error. So now we need to adjust for that error. Overstated 2013 revenue. So that is an overstatement of net income. And I didn't say whether or not this is tax or after tax, so always assume pre-tax unless otherwise stated. So what would this effect have on net income if we're going to consider taxes? It would have been a $2,700 overstatement. All right, so what do we have to do then? Well, in order to reverse the overstatement, we'd have to decrease net income. We are going to alter 2016 retained earnings by decreasing it by 2,700. Right? We want to do it net of tax. This would be a prior period adjustment. That's what these are called. All right. And that concludes that chapter. These are the problems we will walk through in class on Thursday, a little bit more detailed, and stuff that will kind of sink your teeth in there and really kind of figure out what's going on with these things. All right.